Good morning, everybody. Welcome once again to a quick webinar hosted by ourselves, TreasuryONE, in conjunction with ETM Analytics. Today is not our normal webinar. Normally, we just chat about what happens with the currencies and all of that. But today, we're going to chat about the move from Jibar to the new Zaronia index and what does it mean and the reasons why they moved it. George will go into the reasons for it. It's a bit of a technical discussion, but he's going to keep it as easy and understandable as possible. So, George, without anything further, I'm going to hand over to you. Just before that, if you've got any questions while the webinar is on the go, on the right-hand side, you can ask the questions and we'll get to it ASAP. Thanks,
Perfect.
George.
Thank you, Vichard. Morning to everybody. So this is going to be a slightly more technical discussion, but I think a useful one just to put everybody's mind at ease as to what it is exactly that's happening and why it's happening. So if I just shift through the presentation, let's get stuck into it and just give you a little bit of a history of how monetary policy used to get conducted. So what happened in the past was in order to try and control interest rates or control the rate at which interest rates are set, and to make sure that the repo rate, which the Reserve Bank decided on, was reflected in the money market rates and cascades through the entire interest rate market, the Reserve Bank used to operate on what they called a money market shortage system. So they would have a look at the information provided to them from all the banks, and they would see how much overnight liquidity the banks needed at any given point in time. And they would offer the banks close to enough of what they needed, but they always left a little bit short. By doing so, they forced the banks to come to what they call the discount window at the Reserve Bank, and the Reserve Bank used to give them the money that they needed, that little bit of extra top-up that they needed at a particular interest rate. And as a result of doing that, they would force interest rates to set at one or particular rate that they chose, and in the hope that would then cascade through into the money market and then through the rest of the yield curve. That, however, changed in June of this year. So in June of this year, they moved away from a creation of a money market shortage and forcing the banks to come to the Reserve Bank for the remainder, and they transitioned it to what they call a surplus tiered floor system. Simply put, instead of creating a money market shortage, they in fact shifted to giving the banks a surplus of money, but enticing them back to the Reserve Bank at a particular interest rate by giving the ability to deposit those excess funds at a particular interest rate, in the hope that would entice the cascading of a particular interest rate through the rest of the system. It was a precursor to what they are now wanting to do. So that was kind of like a step one in the broader transition, moving from Jibar to Zaronia. And the ultimate idea over here is to move towards best practice that's been undertaken internationally, and to move to what's effectively a more free market system of allowing interest rates to fluctuate, but to more efficiently transmit a particular policy stance through the short-term interest rate system into the rest of the yield curve. So let's go into a little bit of what that looks like. So South Africa is effectively moving in a way that catches up to international best practice. And that international best practice was kicked off towards the end of 2021, when the major economies around the world decided to rather work on what they call a secured overnight finance rate, or the SOFR. So that transition took place, and the reason why it took place was to replace what was then, at the time or prior to that, was called the London Interbank overnight rate. So the LIBOR, that LIBOR rate was a rate that used to be generated from the banks themselves, and the way that they interacted with the central bank, but unfortunately it led to some fraud and collusion. And we saw those LIBOR scandals erupting, especially in the UK, but it also impacted throughout Europe. And as a result of that, the central banks abroad decided that they needed to move away from a system that centralized too much influence in the hands of just the banks themselves, and they looked to try and open that up in a way that would be more inclusive. So it wasn't so that the rate wasn't just set by the banking system itself, but by broader institutions that had a role to play in the establishment of short-term rates. And that could be it could be pension funds, it could be insurance companies, any company that had liabilities and assets that it needed to manage in a money market system. Suddenly were able to participate in what they call the secured overnight finance rate. And so in doing that, they created a system which was not only more transparent, but actually a lot more liquid. And it did away with the ability of the banks to be able to collude amongst themselves and set LIBOR rates at particular levels. So not that South Africa had major Jibar scandals or anything of that nature, but it was deemed appropriate for South Africa to start moving towards international best practice. And that's what effectively this is all about. So the idea here, as is stipulated in, in this chart, is that it reduces the effects of market segmentation. So it's no longer, like I said, centralized just around the commercial banks themselves. Equally, you used to have what we called the shadow banks, where you might have a big financial institution on the side that wanted to lend money elsewhere and would do it via the banking system. Now, all of a sudden, we're doing away with all of that. And instead, we've got a far more transparent, inclusive approach towards the setting of very short-term interest rates. The borrower sample increased as a result of being more inclusive, and so the deal requirements changed. And the objective of all of this at the end of the day was just to make the rate setting a lot more free-floating and transparent, which I believe they've achieved quite a lot. Is also to say that the system that South Africa was operating on goes back many decades. Jibar used to be calculated on an NCD system, which was a 3-month system. So it all revolved around a 3-month interest rate, which in itself was problematic. So if you understand that in the money market world, there is a lot of liquidity that takes place in overnight rates and inter-week type trades that take place, not only in 3-month buckets. And what they found was that utilizing that 3-month NCD system was quite sclerotic, and it created a whole host of problems in how to price shorter-term debt instruments. And to give you some perspective, we're talking about NCDs that were first established in 1964. So we're talking about a very archaic system that ultimately needed to evolve. What worked back then, where 3-month intervals seemed to be sufficient, is not really appropriate for a modern day economy where deals and structures are happening literally intraday and plenty of them. So that liquidity requirement has changed, and through that change in that liquidity requirement, so it was necessary for these benchmark rates that they've utilized to also change. So South Africa started transitioning to what they call the South African Bank Overnight Rate, which is the SARB. And the more the SARB started to gain a prominence and footing within the interbank markets, so it became evident that that liquidity that had arisen within the SARB system gradually would be how the Reserve Bank would evolve to what's effectively international best practice. So there have been interim steps that have been taken by the Reserve Bank, and what we're talking about today really is that evolution to international best practice in a way that will, as I said, enhance transparency, but improve market function. So let's give you an idea of what the changes will look like. Well, in the past, because we were using 3-month instruments, those 3 months NCDs, and we were talking about those 3 months instruments, what you would find is that the Reserve Bank would set its interest rate decision dates, and let's just say there's 6 of them through the course of a year. What you would find is that as time progressed, the 3-month instrument would now sort of take into account not just one, but potentially 2 interest rate decisions. So that 3-month instrument, that 3-month NCD, would span 2 interest rate decisions. Now, it's perfectly fine when your central bank isn't changing interest rates, in which case the outlook for interest rates is nice and stable. But you have a look at what's been happening through the course of this year, for example, where we've been hiking and hiking and hiking at each meeting, and you find that the 3-month instrument suddenly straddles 2 meetings. So that 3-month instrument doesn't only have to take into consideration, for example, an interest rate decision that might happen the week after, but it needs to take into consideration the meeting that will happen 2 months after that as well. And as a result of that, you have that black line that arises. So as you approach each one of these interest rate decisions, you get this ramp up in the 3-month rate, only to reset dramatically lower every single time a decision is taken, because now at least one of the interest rate decisions is factored back out of that 3-month rate. And so it goes towards the next interest rate decision, back down again. And so it progressed through the course of time. Now you can appreciate just by looking at this chart how it generated a lot of volatility and technical difficulties in how to price some of these shorter dated instruments. By comparison, shifting across to a Zaronia approach results in what you see in the blue line over there. And you can see that the volatility in the expectations is far narrower. You do not get these stepped approaches every time you get closer to an interest rate decision. So generally speaking, the spread of changes that are priced into interest rate decisions by the short-term money market is the spread is a lot narrower. And because it's a lot narrower, it tends to result in a more stable, less volatile money market pricing mechanism. So it's a clearer way of the central bank being able to transmit its interest rate decisions through the money market and into the rest of the yield curve. How that gets done is a slightly more technical issue, but I'll try and summarize it very basically for you. So if you have a look at the chart on the left-hand side, you will get a spread of requirements from borrowers and from lenders in the very short-term overnight money market market. And so what they typically did, what they've done with Zaronia is that almost like a bell curve, what they do is they exclude the tails. In other words, the extremes on the top and the extremes on the bottom, and they average out all the other trades and the demand and supply that takes place in between that. So they focus on the average of the trades that are taking place intraday. And that average, that index that they create out of the average is what ultimately becomes the Zaronia rate. So they exclude the tails, the 2 extremes. They focus on the body of the trades that have taken place. They average that out and they arrive at a rate. And if you have a look at the chart on the right, it gives you a sense. It's not that it's perfectly stable. You do get spikes and dips, as you may find supply and demand within the money market rises and falls. It might be big deals that are going through, corporate deals that are going through, whatever it might be. One bank might require a little bit more in the way of liquidity, and so it demands it from another bank which prices it higher. All of that comes out in the wash, but what you tend to find is that it oscillates around the average, which is that orange horizontal line on the side. So you get all of these peaks and spikes, but peaks and troughs, but overall the average gets calculated out of all of that, and you get a far more stable system that ultimately arises. The calculations are done on quite a number of trades. So on the left-hand chart, you'll see that you're talking about anywhere between 3 and 3.5 1,000 trades that take place daily. So that is a fairly liquid market. And if you're talking about the amount of money that we're talking, you're talking something in the order of about R500 million worth of trades that literally takes place on sorry, R500 billion worth of trades. That's how liquid these markets are. It's a derivative market in the main, but that's the amount of liquidity that passes through these systems. If you consider in an average day, all the credit card payments that take place, all the borrowing and lending that takes place, the withdrawals from cash machines, the deposits, business that takes place all the time, this is washing through the banking system, which in turn gets washed through the money market system. And so you've got this constant flow of liquidity that's taking place, which gives you a sense of why it's so important to make sure that there is control of the system to some degree. So the major changes are as follows. They become more inclusive. So the major change is that now it's not just concentrated on the banks and the way that they interact with the Reserve Bank. They open up the market to include a lot more trade than just the interbank market. So that's the first thing. It opens that up. Arm's length rules apply, meaning that you no longer have that ability to influence the market in the way that you used to influence it. So the Reserve Bank now sits slightly removed from the commercial banks, for example. No longer is it a collusive type of environment between the banks themselves and the central bank. This is now far more of a free market system. And the way that the rate is ultimately achieved is also by cutting out the outliers that might reflect an extreme because of bad money market management at one level or another. So as a result of that, you've got a lot more transparency. If you wanted to understand where the bulk of the activity was taking place, well, it takes place in the derivatives market. For those of you that have had occasion to utilize that, that's mainly in your shorter term money markets and FRAs, forward rate agreements, and which is a very short dated swap instrument, if you like. But that's where the bulk of the funding sits. You'd be talking about a figure of about almost 23.5 trillion rands worth of liquidity that's washing around in that derivatives market. That makes up the bulk of it. The rest of it is made up of actual assets and liabilities that get traded by banks and corporates. But in the main, it's the derivatives market, mostly with a roughly 1 year horizon. That's what the data kind of like reflects to us, and affects the way that banks lend on to corporates and the way that banks might lend amongst each other. So in the where are we in the broader process of adopting this new rate? Well, we've been through the design, conceptualization, the design process. That's the first part of it. Then we've basically at the tail end of the transitional and the foundational planning process, where Zaronia has been published, and now we're looking forward to the Zaronia adoption. That's the very right-hand portion of all of this. They haven't given us a strict date as to when this is specifically going to happen. I think they're going through the process with all the banks and the major players in the market to make sure that everybody is up to speed and fully understands how the mechanism is going to work. I suspect that it's going to be implemented within the next probably 3 to 4 months. But there's no hard and fast time frame. But this is, I think, the main point over here. This is nothing to fear. It's a move towards best practice internationally. And in fact, if one has a look at the experience that we've witnessed so far, the rate has actually come in slightly below the previous setting rates, the average of the previous setting rate. So if anything, this makes, because it's more efficient, because it's more transparent, rates might actually drop down by a few basis points, which again would be more in a corporate's favor than against. So final consideration, effective rates will be slightly lower than Jibar traditionally has been, and that's a good thing. Remember that we also don't have that stepped approach as we start crossing over into over different interest rate decision meetings. So that in itself promotes a greater level of stability in the money market. The transition might be a little bit slower than we anticipated. There's a lot of work that's being done in the background, but you'd rather these guys get it right than not. They're effectively just working through some of the technical hurdles that you can imagine, such as fundamental shift within the money market and banking system would require. But we think that it ultimately results in better pricing and better derivatives pricing, greater price discovery, and more liquidity. So all in all, we would give this very much a thumbs up. We would be supportive of this, and we would effectively, the message to corporates is, do not fear this, embrace this. This is a step in the right direction. It's a good thing. And if anything, it will probably work in your favor by virtue of the fact that derivatives that you would often utilize will be priced more correctly and effectively than perhaps has been the case for a while. And I would probably say that this transition is at this point long overdue. So with that, Vekard brings me to the end of this, and very happy to take any questions if anyone's got any.
Yeah, thanks, George. It was very informative. I don't see there's any questions, but just in a nutshell, just to sum it up again, is so effectively, there's one from Warren. He says, are we going to follow the exact same methodology as Sonia, the UK sterling, with lookbacks and observation shifts, and we have a transition period for all derivatives, and will the system to be able to handle the formula?
Yeah, I mean, it's a very good question, and clearly Warren's looked into this a little bit because the chances are that they will utilize some of what the UK's experience has been. We do know that they're in constant communication with them, or so the Reserve Bank tells us. So that wouldn't surprise me at all. I would imagine that whether the system can handle it or not is part of the technical hurdles that they're working through at the moment. So exactly that. They are not going to be rushing into this at any stage. They are going to move when they are absolutely 100% sure that their systems are geared for it, and that they have learned the lessons from international best practice. I think it's always a good thing to not move first in something like this, and South Africa certainly hasn't, and we've got a basis for comparison on how policies have been implemented abroad that we can bring back to SA. But I do know that the Reserve Bank is in constant communication with all the other central banks around the world, so I can absolutely assure you that there's been a lot of interaction between them. And Warren, although I don't know the specific answers to your questions, I don't know if it's the exact same methodology. Each market does have its own nuances. So I don't know if I would be brave enough to say the exact same methodology, but I would say probably quite similar. And in your question as to whether their systems will be able to handle the formula, I suspect that it will, but they're going to test, retest, triple test, quadruple test, before they are comfortable to do that. I do know the personalities at the central bank, and they are quite conservative in that sort of sense. So I wouldn't be too concerned about that. It's probably one of the reasons why they're just taking their time before full implementation.
George, just to, if you don't mind, just elaborating on that. If we look at the regulatory authorities, local regulatory authorities pretty much emulate what the FCA does in the UK. So my thoughts would be that they would very much align with what is happening in the UK, given that the city is generally the flow of capital, right? for this time zone. It would make logical sense. I just have one question on the changeover. Do you see any material changes in the way that the longer dated interest rate hedges that would potentially hit property companies, etc., will be implemented, or is it a case that it's just going to be just a remarking of the book, so to speak? And do you see any major impact, or is this really just a technicality as the changeovers take place?
I don't see major implications for the longer dates. If this is going to impact anything, it's going to impact very much at the very short term liquid portion of the curve. So that's what this is aimed for. But in saying that, the efficient transition of a central bank view and decision making starts at the short end and then cascades through the rest of the yield curve. So the more efficient you get it up front, the better the transmission mechanism through the rest of the curve. So, like I would say that you probably won't get a huge impact, if any at all, in the medium to longer portion of the curve. If there is going to be an impact, it's going to be right at the very short end, and specifically, more to do with the sort of the overnight to 3 month bucket. That's where you're going to see your biggest changes. And from the information that we've received so far, I don't see a lot negative about this at all. If anything, I see greater transparency, more liquidity, more efficient pricing, better price discovery. Like all round, I would say it's a far better system than the system that we were on, which had a lot of legacy issues that needed to be overcome, which the market overcame. But it certainly could be improved on, and I think this is an improvement.
So what you're saying that we really don't have to worry about those that are having any interest rate derivatives on their books having to unwind in due course, or if they need to get out of it, we don't see a massive reset risk here.
No, I don't foresee, certainly not in the medium to longer dates. No, I don't foresee much of a risk at all, and even in the shorter dates, as I said, the experience that we've had so far and the data that's been provided to us by the Reserve Bank is that, if anything, the rates have actually might dip a little bit as opposed to what was the case previously.
And that comes to a question here asked by Quirvis, who says, you say corporates may score in the change mildly with the conversion to Zaronia. Banks added a credit spread that may close this. Any other things to be mindful of as we walk down this road with banks?
Now, off the top of my head, I can't think of anything more. To be honest, like this is all new for all of us. So, I mean, the ultimate proof is going to be in in the implementation and delivery of all of this. But the ultimate objective is certainly to assist price discovery and corporate interaction with banks, not to hinder it. So I don't think that there's anything more that I can add to that, other than there's going to be a lot of engagement and interaction on the part of the commercial banks, just relating all of this information, these changes, to the corporates, and we'll have to, as that happens, we'll begin to understand that little bit better. But from the information that I have at the moment, this is what I can give you. Obviously, there's implementation risk in any change. There's going to be some implementation risk, which I think is the reason why they've taken their time to make sure that they've dotted all their I's and crossed their T's. Beyond that, Quinn, I don't know how much more there is for me to add.
Yeah. So, I mean, from our side, we're just going to keep our eye on things, keep our viewers and readers abreast of any information that we come across, and obviously in conjunction with the portfolio managers of TreasuryONE and ourselves, keeping our clients abreast.
Yeah, exactly that.
So thanks for that, George. Thanks, Quentin. I'm going to wrap it up here. So in a nutshell, it's not too much to worry about. It's a bit of a technicality that's going to happen. So for the corporates, maybe your resets rates, the 3-month Java switching over to Zaronia, maybe your reset rates on a quarterly basis will be slightly lower and you'll benefit a little bit and you'll save a little bit of money there. But for anything else, we'll keep you updated. And if you've got any questions, you're more than welcome to give us a shout. You must all have a wonderful rest of the day.
Weggaard, if I can just add one more thing.
Yes.
As we switch across from these 3-month buckets, you'll probably find that corporates may be given greater flexibility and so you won't have to stick to 3-month reset buckets. You'll be able to do it a lot more flexibly and a lot more transparently than perhaps has been the case right now. So I would say that that's potentially another change to Kobus's question, I guess. But again, I would say that that's more a positive than anything else.
Thanks, George.
So probably every monthly resets now, or 2 monthly resets or whatever. You don't have to do the 3 months, 6 months. Yes. Okay, great.
Great.
All right, thanks everybody. Thanks for your time. It was lovely seeing you all. Have a wonderful day.
Thanks everybody. Have a good day.
Thank you.
Cheers. Bye-bye.